the world's fifth biggest investment bank basically going under. Could what happened to Bear Stearns happen to your local bank and threaten your money? Craig, you say banks on Main Street could be next?
I think it's possible. Of course, if the Fed keeps giving investment banks like Bear Stearns to J.P. Morgan and guarantees all their paper, maybe it won't happen. But I think Bear Stearns is a perfect example of if you expect higher returns, you better expect higher risk. And I think that all the banks are experiencing this. Our top 5 banks in America are holding 98% of $135 trillion in derivatives, interest and credit derivatives. And I think that's catching up with us, and I think we have to be very careful. But it appears that the Fed is ready to do whatever they have to do to keep confidence in the American dollar and the American banking system. I don't think the way they're going about it is correct. I think they're loosening the standards and lowering interest rates are what created the mess that we're in now. We'll see if it works.
But, Jonathan, thanks to the federal government, your deposits are insured by the FDIC at banks, and you have insurance to up to $500,000 on investment accounts at brokerages.
Yeah, but Dagan, I think you'll get your $100,000 back, but it probably won't be worth as much as it was when you put it in. I mean, the truth is there have been bank failures. There's been 2 already this year. I think there was 3 in all of last year and 0 in 2005 and 2006. So, I think, unfortunately, your actual assets are safe, but the value of them, and we've seen the dollar obviously fall precipitously in the last 6 months or year, I think that, unfortunately, that's a trend that's likely to continue.
Oh, boy, Peter, I know you have something to say about that.
Well, Jonathan is 100% right. Nobody's money is safe as long as Ben Bernanke is Fed chairman. It doesn't matter if your bank or your brokerage firm goes under and the government gives you your dollars back. They're not going to give you your purchasing power back. That's the problem. Nobody wants money because they want money. They want purchasing power. Right. And if you get your money back but you lose your purchasing power, you've lost. If people are concerned about their money, they got to get it out of U.S. currency, get it out of dollar-based assets.
With the government security measures in place, are we in danger of a local bank going under and people actually losing their money?
Well, even if they don't go under, they're going to lose their purchasing power.
Wayne.
Is your name Wayne?
Oh, I couldn't hear.
I'm sorry, is your name Wayne? Okay.
I didn't hear.
Well, yeah, okay. Well, just relax here. Dagan, you're absolutely right. No, the FDIC is insured the banks. You are not going to lose. Whether your buying power is not, that's a separate subject. We're talking about whether banks are going to fail or not. The question is the FDIC is going to support the banks. They're going to support your deposits. That is under the law. So you're not going to lose, quote unquote, lose your capital by putting it in a bank.
But Wayne,
let me finish,
yeah,
please. Certain smaller banks may go under, but the federal government will bail them out. That's the purpose of the FDIC. The biggest problem here was the Congress, when they abdicated the Glass-Steagall Act, instead of putting it back, allowing the banks and the investment banks to get together so that you have no correlation over the derivatives market. You have no regulation of the derivatives market. That's the problem that this has caused.
Wayne's 100% right.
What is getting your money back if you can't buy anything?
Because these gold bugs are insane. You put your $100,000 in the bank. It's FDIC insured. You get it back. Okay, there's inflation. You might lose 2% of your purchasing power. That is ridiculous. No one is going to run on a bank because they're going to lose 2% of their purchasing power.
A lot more than 2%.
The bottom line is if we didn't have FDIC insurance right now, we would have had a big panic of epic proportions. People would be running left and right. Every investment bank would be in chaos. We're lucky to have it. I was in a bank that failed last year. I think John was mentioned NetBank. It's gone. ING bought it. Happy as a clam. I'm still getting my interest. I still got my money back. That's the system. It's secure. It's not at risk. And I'll tell you, with gold falling $80 or $90 in a couple of days, it's hard to make the case that that's better than a store of value than
Craig,
money.
Well, just because the commodities boom was a little bit overdone doesn't mean that we're out of the woods by any stretch of the imagination. If you think a couple of days of the Fed lowering rates and loosening standards are going to get us out of this mess of a dropping dollar that's been dropping for 30 years now, Max, I mean, it's just not going to happen.
Bro, the U.S. dollar has not been dropping for 30. There's been inflation for 30 years, but the U.S. dollar goes up and down against other currencies. It was recently very strong.
Maybe you ought to look at the price of a house in 1977 and look at it today. Maybe you ought to look at the price of a new car. You have lost buying power.
Not if you have money in the bank. That is a lie. If you have money in CDs for 30 years, you've not lost buying power. You've beat inflation. In money markets, in CDs, over 30 years, in America, FDIC insured. Gold is where you've lost.
Jonathan, speaking of FDIC insurance, back in the early 90s, you had hundreds of banks that went under, and we still had a booming economy throughout the 90s.
Yeah, but you know, Dagan, honestly, I think it's the FDIC insurance that helps create the problem, because it basically incentivizes banks to take a lot of risk. And of course, people put more research into the purchase of a plasma TV than they do into the solvency of their local financial institution. And once again, the market is not allowed to actually function.
Okay, last
Moral
word.
hazard.
But thanks to all you fellows once again.